Good evening, everyone, and thanks for joining in. We are really excited to launch our second thematic fund, which is the Union Business Cycle Fund. The NFO opens on 13th of February. To discuss about the fund in detail, we have with us our CIO, Mr. Harshad Patwardhan, our co-heads of equity, Mr. Hardik Bora and Mr. Sanjay Bambalkar. We also have our CEO, Mr. G. Pradeep Kumar, and our CMO, Mr. Saurabh Jain. My name is Ishan Amerkar. I work in the products team here. During the call, if you have any questions, please put them in the Q&A tab. Over to you, Harshit sir.
Thank you very much, Ishan. Good evening, everybody. Thanks a lot for giving us this opportunity to talk to all of you. What we propose to do is that I will make opening comments, basically putting in context the logic behind launching this fund. So I will do the introductory remarks and then hand it over to my colleagues Sanjay and Hardik to take you guys in detail about what this fund is about. Now, if you actually think about how the markets behave, most things about market are pretty uncertain. We really don't know what's going to happen. However, it's interesting that there is one thing that is almost certain about the markets, and which is that there will be large dispersion in stock prices of individual stocks, of course, and sectors. Now, if you look at any year, over the last 44, 45 years of history, you will notice that, if it is a up year, down year, or a flat year, doesn't matter. There will always be a big gap between the winning sectors and the sectors that lag the markets. Now, why does this happen? This happens primarily because everything to do with markets and corporate sector is cyclical in nature. Starting from the macro factors, to individual industry factors, to individual company factors, and of course, the sentiment, market sentiment, which goes from euphoria to panics. And that causes this dispersion to happen. As a result of which, it's important to understand the distinction. There is conventional wisdom that equities are for the long term. And we don't disagree with that. Equity as an asset class is indeed for the long term. And you can take a buy and hold approach for equity as an asset class. But when it comes to individual stocks and sectors, if you actually look at the data, you will find that even the bluest of blue companies, take any company, from Sensex or Nifty and look at the history. There have been times when, a great business run by great management, the stock prices of those kind of companies also go through a phase of massive underperformance. So if you, for example, think about the biggest automobile company or the biggest telecom company, you will notice that they have been flat for almost 7, 8, 9, 10 years, massively underperforming even the benchmark. So yes, equities is for the long term, but that is not necessarily true for individual stocks and sectors. So how does one play it? We believe that if you really want to optimize returns over a long period of time, it's very important to embrace the cyclicality inherent in the economy, in the corporate sector, and in the markets, and position yourself based on where you are in the cycle. And that is the theme that we want to play through this new fund, Union Business Cycle Fund. With this, I will hand it over now to my colleagues Sanjay and Hardik to talk in detail about the fund. Over to you guys.
Thanks. Let me share the presentation. I hope it's visible.
Yes, it's visible. We can see it, Sanjay.
Yeah, thank you. So as Harshad gave the pretext to this fund, as we can see, as a matter of fact, every year, whatever the phase of the cycle we are in, let it be growth market, value market, some sectors are in the always in the favor, or there are leading sectors, and some of the sectors are lagging. And that's exactly visible from this chart. So this chart is telling us that come what may, whichever is the phase of the market, there are certain leading sectors and lagging sectors. The blue line represents the leading sectors. And as you can see, let's take example of CY 17. When NSE 500 has given 36% return, the leading sectors have given materially higher returns of 67%, and lagging sectors have delivered 11% returns. And if you take case of recent years, CY 22, when market gave 3%, broad market gave 3% return, leading sectors return 38%, whereas lagging sectors return minus 16%. And there is a wide deviation in the sector performances over a period of time. If you look in detail of these sectors, if again we take a case of, let's say, a large sector, which is a private sector bank, in CY 16, CY 17, CY 18, and CY 19, these are the 4 years when private sector banks were leading sectors and they returned materially higher returns than the broader market, which is indicated by the white box on the screen. But however, there are certain areas, let's say calendar year 20, when private banks materially underperform the broader market. When market Nifty 500 returns 17%, private banks gave minus 3% kind of returns. If you look at on the CY 21, again, private banks were at the bottom of the chart. However, there are certain other sectors like real estate. They are seeing across from over a period of time. If you look at CY 17, they're at the top of the chart with 110% returns. In CY 18, they are at bottom of the chart with minus 33% return. The idea or the fact remains the same, that in over a period of time, we see equity as a broader asset class doing very well, but there are material dispersions. And when you drill down to various sectors, you find these deviations are quite large. No sector consistently ranks best or worst in terms of performance. If you look at sectors like FMCG, on the other side, like real estate and private sector banks, this sector is broadly stable. You don't see material deviation. It's in the middle of the chart as such. And these are the sectors which are more stable in nature. And that is what we try to, our endeavor is to try to understand these cycles play out over a period of time and how to take benefit out of them. This is the anatomy of a particular cycle. When over a period of time, we see all the deviations in the prices, if you try to decipher this cycle into different parts, the chart on the right side of your screen is indicating the same thing, that there are bottoms and peaks. But within those bottom and peak, there is an early upcycle, there is a mid upcycle, there is a late upcycle. So at somewhere, let's say, for example, let's take example of real estate. Somewhere narrative may build that, okay, money has been made in the equity market, and that equity market money will shift over a period of time to the real estate market, leading to boom in the real estate. And that narrative over a period of time shows up in numbers. When numbers show up, stock prices of these stocks start already, which has started going up on narrative, they continue their upward momentum, converting themselves from early to mid upcycle. And to when euphoria kicks in, it converts into late upcycle. And the point to be noted is that cycles are self-correcting in nature. There are various parts of the cycle which play to the benefit or to the detrimental of the same cycle. And the price itself, that pendulum of price which is going in one direction, can reverse after the cycle has played itself. And then the same sector goes from early down cycle to mid down cycle to the late down cycle, where again the bottom formation happens, and again the sector goes for a next level of cycle. However, why this happens, as Harshad alluded, there are intermingling forces which play from the cycle perspective. There are macroeconomic variables like global GDP, interest rates, political stability. There are sectorial variables like demand outlook and supply pressures or capacity utilization for the sector. So as you can understand, the inventory built up in real estate would have acted as a negative force on the real estate sector. And now as inventory has now corrected, that may act as a positive force for the real estate sector itself. There are corporate cycles like competitive intensity, capital expenditure plans, profit margins for the sector. So as we know, telecom sector, which went from 15-player market to almost a 3-player market now. Or if you look at Swiggy and Zomato, from multi-player market, these food delivery platforms have converted into couple-player or maybe 3-player market over a period of time. And that changes everything from the competitive intensity. It's very important from shareholders' perspective that competitive intensity gets reflected in the profit margin over a period of time. And that's why these cycles are very important for us to understand. There are liquidity cycles and market sentiment cycles. So, for example, liquidity cycles, there will be central bank balance sheets. So, we have been talking about developed markets, central banks now shifting their monetary stance and quite restrictive in their balance sheet expansion as such. In fact, their balance sheets may be declining. And these are very important aspects from share market and from investors' perspective to understand where are we in these liquidity cycles. And there are market sentiment cycles like retail investor participation, FDI or FII inflows, geopolitical stability of a country, and these all cycles intermingle with each other ultimately to form the price cycles, which we see in the price movements of Nifty or various stocks or various sectors as such. And that is exactly as a business cycle fund we are trying to target and use fruitfully for the benefit of our investors. May I request my colleague Hardik to take over from here?
Great. Thank you, Sanjay. And what I will do is for the next 3 slides, I will try to explain about why our business cycle fund can be expected to be different, or what are we trying to do specifically to this particular category and in this strategy. So on this slide, if you look at what we are trying to do, it is broadly encapsulated here. The points that I will borrow from what Harshad and Sanjay have said is that we are appreciating that there are multiple factors that cause cycles to come up and down in a particular sector. Once we have understood what those factors are and we are closely monitoring them, we will identify what are the right sectors to play at any particular point of time. What we will do is, accordingly, we will focus on these sectors in a much more aggressive fashion. When I mean aggressive, it means that our overweight sectors which we feel are going to do well in the near term will be relatively aggressive. And we will also aggressively be underweight on sectors where we feel that the current price cycle is not in their favor, where we don't feel that we will make superior returns in the near term. So the point over here is one important distinction for us will be we will be very aggressive in our allocation to which sectors to play and which sectors to be underweight on. Now you will appreciate the point in the coming slide whenever we come to it as to how exactly will it look like. But also while doing this, we are not going to ignore any market cap categorization. We will play this across all market cap categories. And this top-down sector selection top-down approach will be applied to identify which sectors to play in this particular fund. Once we have identified which sectors appear to be the best, we will not then restrict ourselves to only buying into mid caps or small caps or large cap. We will try to play across the spectrum where we feel the wealth can be created in the most meaningful way for our investors. So it will be market cap agnostic to that effect. But I think one point that is also very important, which is the final 5th point on this slide, is that as Sanjay highlighted in the previous slides, that any sector does not necessarily do well year over year for multiple years. The sectors which do well in any given year keep changing for every 1-2 years to the next year. So the idea also is to be dynamic about this. This will not be a status quo fund where once we have taken a sectoral call, we will buy and hold on onto that sector. The idea is to move on to the next sector where the cycle is about to pick up and move out of the sector where the cycle is about to end, and try to do that constantly so that we are able to stay on top of the market. So this is the uniqueness. If I was to leave this slide with 2 points, it is about playing sectors aggressively across and using all the market caps to play that sector, and also be underweight sectors aggressively. And the second point would be to do this in a dynamic fashion, not apply a buy and hold on a particular sector and hold on to it. So that is the uniqueness of our fund. If we come to the next slide, you will see that the make of the fund would resemble something like what we have here. So we have on the left side the sectoral breakup of the benchmark. There are 22 sectors to be precise on the AMFI and 11 GICS sector. Now, of course, many sectors fall sometimes under the same gamut. Industrial products and industrial consumables might be in the same basket. Consumer theme can be played in multiple areas. What we are trying to depict on the right-hand side is not that we will play only 5 or 6 sectors in this fund. You can say that 4 or 5 or 6 sectors will be major overweight sectors in the fund. There might be more than 5-6 sectors in the portfolio, but our overweight sectors majorly will be few. So this slide is to depict that few sectors will be the main drivers of the fund's alpha. in any particular year. And also at the same time, the sectors that don't show are also going to be a facilitator to that alpha. So the idea is to try to win on both ends by being overweight on the sectors we feel will do well, and also be underweight on sectors which we feel won't do well. That's the broad point we want to depict from this slide. And if you were to ask us, where does this fund sit across all the portfolio that we have, this will be a relatively more risky fund from our basket. It will only be riskiness. It will be only fourth to the mid, small, and innovation fund that we have launched in terms of riskiness. The riskiness, as you can understand, will be high with respect to the benchmark. And that is because of the fact that we will be overweight and underweight materially. And our active share can be relatively quite high compared to the benchmark. So for that reason, the riskiness of this portfolio is expected to be relatively higher. So that is in brief about what Union Mutual Fund intends to do with this business cycle category and how we intend to play that. With that, Saurabh, may I hand it over to you back?
Yeah. Thanks, Sanjay, Hardik, and Harshad. There's a request. If you can give that pitch without the presentation in 2-3 minutes in Hindi also, it will help many of our distributors.
Sure. Let me try to do that. So इस फंड के माध्यम से हम हमारी अल्फा यानी कि बेंचमार्क को बीट करने की जो नीति होगी वो ये होगी कि हम जो सेक्टर साल दर साल अच्छा करते हैं हर साल, तो इसको हम 3 पार्ट में दर्शाते हैं. पहली चीज, कोई ऐसा सेक्टर नहीं है जो हर साल अच्छे से परफॉर्म करता है, और हर साल कोई सेक्टर होते हैं जो बेंचमार्क को बहुत अच्छे से बीट करते हैं, और कुछ सेक्टर उसी साल रिलेटिवली कम परफॉर्मेंस देते हैं. तो जैसे अगर आप इस स्लाइड में देखें तो कैलेंडर ईयर 2022 में जो डॉट है वो आपको बताएगा कि भले बेंचमार्क ने 3% रिटर्न दिया था. एक्चुअली दे डोंट वांट द स्लाइड, सो आई जस्ट गिव अ पेज, एलिवेटर पेज. तो हर साल बेसिकली कोई सेक्टर होते हैं जो बेटर रिटर्न देते हैं और कुछ सेक्टर है जो कम रिटर्न देते हैं. अगर हम ऐसी एक स्ट्रैटेजी बना पाए या ऐसा एक प्रोडक्ट मैनेज कर पाए जिसमें हम वो सेक्टर्स पे फोकस करें जो उस साल के लिए या आने वाले 1-2 साल के लिए अच्छे परफॉर्मेंस देंगे, और उन सेक्टर्स पे अंडरवेट जाए या इग्नोर करें जो आने वाले 1 या 2 साल के लिए कम परफॉर्मेंस देंगे, तो हम शायद से बेंचमार्क को बीट करने की ज्यादा क्षमता रख पाएंगे. सो इस ऑब्जेक्टिव से हमने इस फंड को लॉन्च किया है. अब ये एक तो सेक्टर्स अलग होते हैं और हर 2 साल 1 साल में बदलते रहते हैं. तो ये स्ट्रैटेजी खेलने के लिए हमें हर 1 साल 2 साल में हमारे पोर्टफोलियो को ध्यान रखकर चेंज करना पड़ेगा ताकि हम उन सेक्टर्स पे फोकस कर सके. ये फंड स्पेसिफिकली इसके लिए लॉन्च किया गया है क्योंकि हमारे फ्लेक्सी कैप और दूसरे फंड्स में हम एक डाइवर्सिफाइड पोर्टफोलियो रखते हैं जिसमें हम ऑल वेदर फंड की तरह रखने की कोशिश करते हैं. यहाँ पे हम स्पेसिफिकली कोई सेक्टर्स को अग्रेसिवली खेलेंगे और ये फंड की विशेषता वो होगी. ऑब्जेक्टिव यही होगा कि हम निम्बल रहें, यानी कि हम बहुत जल्दी पोर्टफोलियो को चेंज करें. जल्दी का मतलब है हर 1-2 महीने में नहीं, लेकिन आने वाले 1 साल में जब भी हमें लगता है कि कोई सेक्टर में चेंज आ रही है तो उसको चेंज करें, और जो सेक्टर अच्छा करने वाले हैं हमारे मुताबिक हम उन सेक्टर्स पे स्ट्रॉन्ग पोजीशन यानी काफी ओवरवेट रखें. ये इस फंड की मेन विशेषता है. रिस्कीनेस के हिसाब से ये हमारे मिड कैप, स्मॉल कैप और इनोवेशन फंड से रिलेटिवली कम रिस्की हैं, बट हमारे बाकी के प्रोडक्ट पोर्टफोलियो से ज्यादा रिस्की हैं. रिस्की का मतलब बेंचमार्क के मुताबिक के मुकाबले इनका परफॉर्मेंस काफी ऊपर या नीचे हो सकता है टाइम टू टाइम इस फंड का.
Thanks, Hardik. The next question is that markets are at an all-time high and valuations are looking expensive. Why are we launching a fund like this right now?
Great. So I'll take this question. See, markets were at an all-time high when we also launched the multi-cap fund a year ago. And since then also the markets have given a very strong return. So as we have time and again said, that markets being at an all-time high is not necessarily the reason to launch or not launch a fund. The question is, while the markets are where they are, where are the valuations? As per us, markets are today in the fair zone. About 2 months ago, somewhere in November, the markets were in a very relatively attractive zone as we communicated to all of you. Now they are in the fair zone, which means that they are not expensive, first of all. You can still expect reasonable return. This is the opinion on the overall market. The reason why we are launching this fund is there are some sectors which are more attractive than others. The objective of a portfolio like this is to identify which are those sectors and play those sectors aggressively. If investors want to play the equity market, this portfolio will help them play that section of the equity market, which can do better probably in the near term, and be materially overweight that sector of the equity market, which can do relatively weaker in the next 1 or 2 years. So that is why we don't feel all-time high means this is the wrong time. Time and again, that has been proven that 75% of the times market keeps hitting a new high. B, this sector specific Union Business Cycle Fund also ends up giving the ability to be overweight in the right sectors, even if the market looks like it's expensive. Sanjay, you want to add anything?
No, I think you covered it quite well. Just one point which I wanted to reiterate, that from whatever phase in the market, there will always be leading sector and lagging sectors. And for this fund, it will be very, very crucial on the fund manager's part to identify which sectors are going to do well in advance and be positioned there. That's why, irrespective of the market positioning, I think this fund has a separate investment argument on its own. And that's why this fund makes sense from the investor's point of view.
The next question is, what if the sector goes wrong in terms of picking up? What are the course correction, or how quickly will you look to change it? Because there are chances the sectors may go wrong in the fund.
No, it's a good question. So yes, as a fund manager or as a investor, we always have to be open to the thesis that what is happening with our investments. As we have tested across our investment process over time and again, we have seen that our process is able to capture the upsides through the fair value approach. And a lot of work goes on to identify what is the fair value and how fair value fits in from the long-term perspective. But from this fund particularly, we'll have to be open to the fact that what is our investment hypothesis, and we have to track all the data points for that investment hypothesis. If data points or facts change, we will also have to change. At least endeavor or ambition would be to capture sectors in advance and capture them rightly.
Thanks, Sanjay. The next question is, the same strategy can be done in other funds. So why have a separate fund for this strategy?
Yeah, so let me start and maybe request Hardik also to contribute. So, the strategy in a way gets reflected across the portfolios. However, this is a very special thematic fund in which overweight or underweight on the sectors can be played much more aggressively. So as Hardik alluded, we will be maybe absent, or this is more of a select sector fund where we may be absent from from the index perspective. We may be absent from the even larger sectors as such. Just to give you an example, let's say if we take off BFSI is a fairly significant portion, almost 28% of the index weight. However, there are 4 or 5 components for the BFSI. There are PSU banks, there are private banks, there are NBFCs, there are fintechs, capital marketplace, there are insurances like general insurance, life insurance. So these 6-7 components are there. In the diversified product, we may go overweight or underweight this sector mildly, but however, in this product, we can significantly deviate from the benchmark. That's why the riskiness of this product is also a bit different. We may choose to be completely zero in some of the sub-segments as well. If you take case of auto or auto ancillary, in the wrong, at the right time in the cycle, we may go significantly overweight, but at the other side of the cycle, we may go materially underweight. We can be absent also from this sector. So that needs to be kept in mind while allocating to this product. And that's why we thought that it is better that we launch a separate product, because that ability to deviate materially actually is then understood, and investors are also thinking from that perspective that it is not a completely diversified product, but it's a select sector product. Hardik, anything you want to add?
Yes. So just to say that, in keeping with our AMC's ethos, we always intend to launch and manage true to label portfolios. In our FlexiCap fund also, technically, we have the ability to run a small and mid cap strategy, be 80% positioned in mid and small caps. There is also the capability to be have heavy positions in certain stocks in our small cap and mid cap funds. Also, we can take cash call from time to time, technically speaking. But when we have communicated to you in the past, we've always emphasized on the fact that we want to manage a portfolio which is true to its label. A flexi-cap fund is supposed to be diversified and is not supposed to take outsized bets in any particular market cap category. Similarly, in small caps and mid caps, you will never find any stock that is 7-8% of our portfolios. So every category and every scheme has its own risk parameters on which the investor is benefiting from, and that risk parameter will help generate alpha. In small cap, mid caps, it's smaller companies. In focus funds, it's the concentration level in portfolios. In flexi cap, it is the nimbleness to move between large, mid, and small from time to time. And balance advantage funds are basically using the asset allocation to generate return across market cycles. This fund in specific is playing on the sector rotation in a much meaningful way. So it is a specific risk criteria that we are playing through. We are not mixing it with our flexi cap fund, which has a different strategy, which Sanjay rightly said that it's not that we are not playing it. If we are underweight consumer discretionary at any point of time, it will be underweight everywhere. But the extent to which we will play it underweight will be higher here. So the investor gets the maximum benefit of that sector call through this fund.
Thanks, Hardik. The next question is, how different is the fund from a value or a contra fund?
Interesting question. So in the value or contra, typically idea is to capture underpriced opportunities at any given point, and that can be function of anything. That can be function of either market has given, let's say, has corrected significantly, sector not being in favor. So which typically case, let's say in Corona time, when aviation sector was not in favor, aviation stocks had declined materially. Here, the idea is to capture the upside from selecting the right sector at the right time. We want to target that which sectors which are leading in nature, which are either at the start of the uptrend or in the uptrend. We have to capture or allocate more capital to those sectors, and we have to be either absent or significantly underweight from the sectors which are downward in nature. So, from value versus value and contra, I would put this fund as here sector selection will be quite focused. There will be fewer number of sectors, and in value, there will be certain sectors which were unfavorable from the market perspective. In this fund, that is not the context. Here, we will have to capture sectors which are in the uptrend or which have started or expected to be in uptrend soon. That is how I will put it versus value fund. Particularly in our value product, we also play or we have significant allocation to special situations like turnaround or merger, demerger, those kind of special situations. Almost 20% of the bucket is allocated to that kind of allocation. In this product, there is no special allocation to that special situation or turnaround kind of bucket.
Okay, thanks, Sanjay. The next question is, what is the risk if the current governments come back into power?
Comes back into the power.
Yeah. So this is the other one. So the risk we have talked about is the continuity of government. If it doesn't happen, the question has come that if it actually comes, what is the risk of the market for the market?
In my opinion, policy continuity in a way is a base case with which market is working. So majority of the market participants are expecting that policy continuity will happen, that current government policies will be continued for some period of time. In my opinion, if policy continuity happens, it's not a major risk. If at all, it's an upside risk. That upward risk may be there to the market from policy continuity perspective, and that is what we should be aware of. If other way around, other case happens that policy continuity doesn't happen, that would lead to a significant that opening up of a significant downward potential moment from the market perspective.
Thanks, Sanjay. The next question is that many of the funds came out with business cycle fund a year back. Aren't we late in launching a fund like that? We have already answered, but if you can take it again.
Well, I don't think that is necessarily true in terms of timing perspective per se. We were, of course, we had quite a lot of interesting products to look at first. We launched a multi-cap fund, we launched an innovation fund, which we felt was the right time to launch them. So I don't think that we necessarily see it from the lens that this could have been only done better if it was launched a year ago. Valuation wise, we don't personally feel that is necessarily a challenge. I would argue that the conversation that we were having during the launch of our multi-cap fund, valuation levels were somewhere in the same region. They appeared to be fair. They were not very attractive. Markets were in the fair zone back then as well. So I don't think if I was to answer this from a valuation perspective, we are necessarily in any subpar position. I keep using this anecdote that if an economy is growing at the pace as our economy is, then markets hitting an all-time high should be the norm rather than the exception. And to that extent, I believe that just because markets are at this level doesn't mean that any prospective returns should necessarily be inferior. What we have to look at is valuations. We don't feel they are unfavorable. To an extent, yes. The better way to we feel to also going forward generate alpha is to be more selective in certain sectors. And I think this portfolio hence seem to be perfectly timed to do that given where we are today.
And can I add something here?
Yeah, sure, Pradeep.
Yeah. So it's also the philosophy of our fund house to launch funds which are sustainable for the long term. So we don't launch flavor of the month funds. So we won't launch, say a business cycle fund if we thought that this opportunity is there only for the next 2 weeks. We believe that, this is an opportunity which will be there for the long term. And we launch a fund, NFO is just the beginning. And this fund will grow and this opportunity also will grow in size over time. So your starting point is actually immaterial. Whether you launch the fund 1 year back or, now or 1 year from now is in the long run immaterial. We believe it's a good long-term opportunity. Those who have money today, they can come today. Those who get money 1 year from now, they can invest at that point of time also. And that is the way funds grow. So we are not a fund house which will just try to grab a flavor of the month, 1 month opportunity and launch an NFO and run. So yeah, this is a fund for the long term, really.
Yeah. So the next question is, what is the investment or portfolio strategy for the fund? So
Yeah.
if I can,
So please
go ahead.
Go ahead. So
Yeah, so like we said, there's a fund where we look at the top-down approach first. So we look at the sectors which can be the leading sectors in the in the years to come. After identifying the sector, we do look at the bottom up in those sectors which are the companies which are looking best in terms of risk and return, right? From a longer term perspective. So that's a portfolio strategy. Sanjay, if you want to add anything on the.
No, I think you covered it quite well, Saurabh. So this is a combination of top-down and bottom-up approach for the fund. Particularly, sector will be selected from the top-down approach. As I said, there are intermingling forces of multiple cycles which come to form a business cycle or come to form a market cycle. That would be the identification criteria from the sectoral perspective. Within that sector, which companies to choose will be a bottom-up analysis at a fund management and investment team level, that which stocks in that particular sector are looking quite well. Again, this will be less diversified product versus our other diversified product. There will be select sectors on which will be materially overweight or materially underweight. In fact, actually, some of the sectors will be absent as such from this fund. Fund will allocate money across market cap curves, which is large cap, mid cap, and small cap. No cash calls will be taken at our end. And deployment, there is a particular strategy which we have similar to innovation product. We have a specific strategy in mind. There is a clear-cut identification of at what levels we would deploy. So that deployment strategy is also quite in place. So that would be the overall investment strategy from this fund's perspective.
Some of the sectors are very broad in nature. So when you look at a financials, a pharma, or an automobile, so do you look at it only at a broader level, or you will look at a subsector level also?
Sure. Certain broader sectors, we would like to split them in subsegments. For example, auto can be a large sector. However, there will be auto OEMs, original equipment manufacturers. There are auto ancillaries, which help auto OEMs to manufacture the product. even in auto OEMs, you will find that there are players which actually play into CV or commercial vehicles kind of a side. There are certain players on the personal vehicles, cars, and SUV style kind of products. There are certain players which manufacture two wheelers, and there are certain host of auto ancillaries which feed into each of these cycles. CV cycle may be at a very different stage of the at any given point in the economy than where the two-wheeler cycle may be, because two-wheeler may be more of a utility kind of a vehicle, or more of a requirement from the personal daily use perspective, whereas CV cycle may be more linked to the economy, where economy is going, what kind of demand supply growth we are seeing in the overall economy, where what kind of growth rate we are expecting in the economy. So these two cycles have very different forces or economic forces which are working behind the scene, and that's what we would take cognizance of, and that's how we will choose to allocate our money. Or let's say if you look at even banking sector, as I mentioned, there are 6 or 7 parts to the banking sector as such. There are PSU banks, there are private banks, there are insurance companies, there are fintechs, and different economic variables or economic forces may have repercussions on the stock prices of these companies. So for example, interest rates may have very different repercussions for what we should see, the impact of rising interest rate or declining interest rate on a private bank versus a fintech. And that's what will take particular cognizance will be given to these market cycles, and that's how we would like to choose when we are allocating money. So in the larger broader context like banking sector, you may see that we will be significantly overweight or underweight the sector irrespective of its weight. And in some of the sectors like IT, or let's say automobiles or FMCG, we may be either materially overweight or we may be completely absent from these sectors. That is how we will choose to allocate.
What's the duration that you would recommend to an investor who is looking to come into this fund? What time frame he should be coming for, minimum?
So as we recommend for all our equity products, minimum of 3 years horizon is required when a person is entering or investor is looking at any equity product. From this particular fund perspective, as this is in a way select sector fund where benefit of leading and lagging sector may accrue to the investor over a period of time, I would recommend that investors should see this product from 3 to 5 years perspective. At least minimum 3 years is the horizon which one should be looking at when entering the product.
And looking at the current market valuation, sorry, before that I'll take another question. Will this portfolio be large cap biased as of today's valuation?
So difficult to mention because markets are changing every day, to be honest with you. This will have mix of large, mid as well as small. However, in my opinion, it will not be right to look at this product from a market capital bias where it is large cap, small cap or mid cap. This is a pure sector allocation product. So one should be looking or focusing on the sector allocation rather than the market cap allocation in the fund.
Okay. And what would you recommend to an investor who's coming right now? He should come through lump sum or STP mode?
From all the equity product perspective, we are recommending that from the large cap and flexi cap product perspective, it may be right to come into lump sum. From all other product perspective, we are recommending that they should have at least 6 to 9 months kind of a SIP or STP route to enter into all the other products. So this product being the riskier, it has allocation across large, mid, small. I will mention that from entering perspective, at least have disciplined approach of 6 to 9 months of entry from this product perspective also. If somebody doesn't have any allocation in this product and want to start a fresh allocation for business cycle, maybe a start can be done from allocation in lump sum way. However, entry over staggered manner, a disciplined approach for entry and exit would be recommended.
Yeah, and we've also launched a smart stagger plan, which is an STP, a smart STP. I would request Ishan to take us through it. Right now, it is applicable for this fund, and we'll be launching it for all our other equity funds in time to come. So, Ishan, can you take quickly as to what is the smart staggered plan?
Sure. So hi everyone. This is a facility which we are launching with our business cycle fund NFO. The aim is to provide an entry point for an investor who wants to stagger his investments over a predefined interval. Given the current market situation, there are always times where an investor would feel currently it is not the right time to enter. Here is where we provide him an option to stagger his investments over a predefined interval. And at the same time, what we are also trying to ensure through this facility is that to being able to capture the market, the short-term market corrections. This is an investment strategy which will not only space out the investments over some predefined time, but also be able to capture the short-term market corrections. I'll quickly show you an example for the same. So let's say during the NFO, someone chooses to enter into our business cycle fund in a 3-month or a 6-month option. 20% of the investments will go in the NFO scheme during the allotment. 20% will go in the NFO scheme. 80% will be moved on to our Union Money Market Fund, which will be spaced out over the rest 2 installments in a 3-month option. Similarly, for a 6-month option, 20% again will go on in the allotment during the NFO, and the rest 80% again would be spread out over the next 5 months. What this ensures is that the key major events coming forward, again, there will be an even exposure, a balanced exposure for the investor. He can choose to spread out his investments over a 3-month, 6-month, 9-month, or a 12-month option. And also, every trigger here will be based on a 3% fall in the target scheme scenario. That is our business cycle fund. So let's say an investor enters during the NFO. He gets a NAV. For simplicity, we'll let's say assume 100 rupees. He gets a NAV of 100. Whenever there is a 3% fall from 100 rupees NAV, the first installment would be triggered. If there isn't any 3% fall, the investment would be triggered on the second last business day. Let's say there is an investment which is triggered at a 3% fall of 97. The next investment would be triggered on a further 3% fall from this 97 rupees. In a situation when there is not a fall, let's say the investment rallies from the 97 NAV, again the second last business day would be considered. So what we are trying to do here is that blend a staggered approach into investment and also take benefit from the short-term market corrections. Just to give you all a brief about the 9-month and the 12-month option, 20% again during the allotment. The 80% in a 9-month option would be spread across evenly in 10% each across the next 8 months. And for a 12-month option, 7.25% over the next 11 months.
Thank you, Ishan. So this features people who are apprehensive on the market level and really don't know which way the markets are headed. This is a great option for the distributors and like investors, where it like works like an STP. The only difference is that in case the market corrects in the month by 3%, it will take that into account and the like money will move into the into the scheme. So you can park the money in like money market and the overnight fund, either of the two funds, right?
For now, it is only the money market fund.
Money market fund. Okay. The next question is, will the portfolio churn be high because we are looking at sector rotation? So compared to our other funds, will the churn be higher in this?
Not necessarily. We would look to rotate sectors very actively. So that depends on the opportunities which come to us, how economy behaves, how different sectors also behave. By looking at, let's say, I give you example of private sector banks. See, they were in favor for 4 years from CY 16 to 16, 17, 18, 19, right? So those kind of cycles, it is not necessarily that they will come to an end very abruptly. So when we get the cycle right, we will take the full benefit of the cycle. We'll try to ride the sector from for the full up cycle, and that whether the churn will happen very quickly or not, that depends on how market will be, whether the market will be volatile, what kind of economic cycle we are playing into. So we'll try to be on top of it. We'll try to rotate the sectors quite materially. That may lead to higher churn for some period of time, but not necessarily.
Okay. A follow-up question on this is that some of the cycles are very short by nature, sector cycles. So case in point is a real estate. So would the fund be looking at these kind of cycles also, which are very short by nature comparatively to other sectors?
Absolutely, absolutely. The basic idea of targeting these business cycles is also to capture various cycles over which are happening across the market. So as I discussed, there will be different cycles playing through different sectors. Even within the sectors, there will be raw material cycles as well as the pricing cycles for the companies. We'll try to capture all the cycles and take the benefit out of them.
Thanks. Now the most asked question, there are some 20 odd questions is on the same thing. What are the sectors which are looking attractive for 2024?
Right. So I will give you the current outlook where we are positive on and where we are cautious. And we will look at this outlook gets revised every day. Honestly, from the fund manager's perspective, if the situation changes, obviously we'll also change the outlook. But as of now, as the situation stands, we are quite positive on sectors like auto ancillary, because interest rate cyclicals are the theme. As of now, auto cycle is going, last cycle peak was in FY19, and now again the demand curve is shifting in favor of these companies. So that's why auto sector is looking quite good. Second sector we are quite positive on is on the NBFCs as well as on the PSU banking side, as the cycle is favoring them, and also the growth is coming back to these companies. Credit cost is not on the horizon as of now, and that is what is making us positive on the companies like PSU banks as well as NBFCs. Another area which we are positive on is industrials. Manufacturing is a theme very well discussed in our last both NFOs of Multicap as well as on the Innovation and Opportunities Fund. We think that theme is continuing. And that's why, as Saurabh just asked the question, some sectors can be long lasting, some sectors can be very short and quick. Industrial sector is going through that upcycle, and we think that manufacturing as a theme is here to stay. As India, particularly on the income tax side, on the labor cost side, is becoming more and more competitive from the global context, as our logistics costs are coming down, we think that industrial sector and manufacturing theme is a fantastic theme from investors' perspective. We are also quite positive on the power utility side. Sudden jump in the demand for the power, backed by the new level of demand overall in the economy, is driving the power sector quite well. So power sector utilities is another theme which we are positive on. And lastly, real estate is another sector which we are quite positive on. I think all the wrongdoings of last sectors seems to be correcting itself. And these are typically real estate sector goes through a long cycle from the demand supply perspective. And that's another sector which we are quite positive on. Where we are cautious is on the export driven sectors, particularly on the commodities and chemicals. That is where we are quite cautious. Another area we are cautious is actually on the consumer staples, because of the rural slowdown and overall demand still seeing depressed. That is another area we are cautious on.
Thanks, Sanjay. So the next question is that do we have an internal cap on how much deviation will take it from the benchmark on the sector call?
No, we are quite open, and we will back our calls confidently. Wherever we are positive, we will back that sector quite well. And where we are negative on the sector, it can be completely absent. That's why this separate product proposition of the business cycle fund as such. So there is no cap internally from our perspective.
Okay. The next question is, which I will take, is on the target amount for the fund. So we are looking to raise 500 crore plus from the fund, because there is a lot of demand for this kind of product. Because as you are aware, many of the people understand that business cycle fund is meant for all kinds of market. So there are sectors which will be leading, and there are sectors which will be lagging at all points of time. So we are looking to raise 500 crore plus in the fund. I have covered all the NFO questions. Now there are certain questions which are apart from NFO. I'll take them up. So the next most highly asked question is on the Paytm, and it's in our innovation fund. What's our view on the stock?
Yes, so we typically don't engage in stock specific discussions. What I can tell you is the reason why we had it in the portfolio. Broadly, I can just give you the broad rationale. And of course, as time progresses, we will keep reviewing this. The company was making, uh, I would say, relatively very strong profits from even the payment services business. The lending business that Paytm does was not really a major contributor to the overall profitability as the payment service, that is the UPI payments or the wallet related payments that the company does. It was in fact gaining a healthy margin, net payment margin of close to about 15 bips per 100 rupees of transactions done. So it was a very good payment that the company was getting, and that itself was reporting a very strong growth. How much ever profits the company would have made by achieving greater scale on the lending side would have been over and above that. But this piece of payments itself, when we take UPI payment or when we made payment on FASTag, all of that itself was showing a very rapid growth. Now, with the development that has happened recently, some of these growth engines have been hit, and to that extent, there will be a medium temporary short term impact on the business's profitability. We are reviewing closely what the overall situation is. What I can tell you as a fact is that this stock was held more widely in our AMC after the development that happened in the month of December. We have exited the stock from almost all funds except for the innovation fund, as rightly some of you might know and sort of highlighted. And we are reviewing that position as well. I, of course, will not be able to share any further on this, but we believe that the long term potential of the company is pretty strong, and that is why it was there part of our innovation portfolio, which typically tries to benefit from companies which are seeing business growth faster than potentially nominal GDP as well.
Just one point I would mention that this would be the typical nature of any innovative company. Because the company is innovative, overall ecosystem is also developing. It will be quite natural that the sectors, regulation, everything would be undergoing significant changes. So, particularly in the innovation and opportunities fund, we should be open to opportunities which can be at least seen some impact from the regulation changes as well.
Thanks, Sanjay. There's a question on the fund, on the business cycle fund. Will we be taking exposure to derivatives hedging or debt in the fund?
So there is an enablement in the SID, or as of now, we don't envisage just taking a position from the derivative point of view.
Okay. And Ishan, if you can answer the next question. In the Smart Stagger plan, the 3% fall will be taken on the regular or direct plan. I think it is a plan that the investor is on. So
Correct.
each investor will have their own pricing mechanism. And it is not only for the NFO, even after the NFO, a person can use the facility. So it is really your investment, which is the trigger point, the NAV of your investment, not a uniform NAV. Is that correct, Ishan?
Correct.
Yeah. There's another question on the other funds that recently we have seen a dip in the performance of the schemes. If you can shed some light on that.
Sure.
So yes, so what we do, of course, is that, as you know, when we were even having the conversations last year in January and even the previous year, December, we keep tracking the performance of our portfolio companies on a very regular basis, both from stock price performance as well as the business performance. Whenever we observe that our companies are actually reporting faster revenue and profit growth, and also are relatively better in terms of quality, we typically don't fret too much about the near-term performance, because we know that eventually stock prices will come in line with the fundamentals. So I can mention at least two things when we talk about things from this perspective. One, the strength of our portfolio continues to remain strong. The companies that we hold, as their quarterly results went in September quarter and as the quarterly results went in December, both that are going on through actually in the December quarter, which we are currently underway, as you know, our portfolios and the companies that we own are basically delivering superior growth across the sectors that they are present in. So we don't see any challenge on that particular from that perspective, and we believe that our portfolio quality is pretty strong. Now, what has happened in the recent months, and those of you who are maybe tracking our performance closely would appreciate this better, that predominantly it was the month of December, which sort of saw a relative, underperformance versus the benchmark and the category. And what has happened in the month of December was an abrupt move, especially after the state election outcomes were out, as you would all know, on December 4th. This basically resulted in a huge catch-up rally. Why do I say catch-up? If you look at the momentum score that we track until December, the stocks which were in a very strong positive momentum suddenly saw that those stocks took a breather, and the stocks which had not done well so far in the calendar year for 11 months till November suddenly started participating. Certain sectors like pharmaceuticals, chemicals, even logistics, other building material space, these are stocks which had not received much attention, primarily because their business growth was not superior in the year. So they were not doing well business wise. And hence the stock price also was not doing well. And many people also expected probably the next year will be a rally. So maybe these stocks will recover. Notwithstanding, whichever way you look at it, some of these stocks have seen a sharper increase in their stock prices in the month of December. Whereas the other companies which have seen better business growth, they took a pause in the month of December, and this happened too abruptly. So either you were positioned in such companies or you were not, and that resulted in our portfolio companies or rather our portfolios in general seeing this kind of a break. Having said that, if you look at our performance on an annual basis, we are still doing slightly better than average or close to average across categories. And more importantly, as the month of January and some part of February has gone, performance is also showing that in the last 1 month, things have come back to normalcy. So this December month was the weird month of sorts. The change in the underlying market factors was abrupt. It was very difficult to, of course, capture anything like this if it just takes such a sharp move in just a few weeks. What all we can do is ensure that the portfolio quality remains strong. These short-term vagaries will come from time to time. There is nothing else to report in terms of how we are doing things. What I can only add over and above this is that we are very cognizant of, as Harshad and the whole investment team has now been communicating with you, that long-term is a series of short-term. So we very closely track what is going on in the market, and wherever we feel that there is a need to change our portfolio strategy, allocation in certain tactical sectors, or place some stocks or sectors defensively, we keep doing that from time to time. It is for this reason why, despite the month of December being what it is, and despite the whole of calendar year 23 being a very strong momentum driven or certain low growth or low ROE driven rally as far as factors are concerned, we have tried to pay attention to all quadrants of the market, and hence our portfolios are not appearing significantly below average anywhere on a 1 year basis. So this phenomenon was short-lived. It only happened in the month of December. We are aware what has happened, and we are confident that things will reverse. In fact, as time has gone in the month of Jan, a good part of normalization has already happened, as you would be watching it closely.
Sir, we are on mute.
Sorry. There's another question on the NFO. Will you be using momentum strategy?
No, I don't think we necessarily have any momentum strategy that we apply as such. So no, momentum will not be part of this fund strategy. In fact, we don't necessarily have a momentum strategy in any fund, so to say. It's not part of our investment process yet. This fund will specifically look at the business cycles. If a sector is going through a positive cycle, अगर वो सेक्टर में अभी हम देखें कि पहले मंदी थी, डिमांड स्लो डाउन था और अभी शायद से उसमें डिमांड में काफी पिकअप आ रही है, that is why you will play a sector. So it is to play a sector based on its own merit, the demand cycle improving, business profits of the sector improving. That is what we will play.
Thanks. Pradeep, request if you can take the next question, which is on update on Union AMC, and if you can also give why distributors should look at Union AMC.
Well, I think, the reasons that we have been saying for at least the last 6 or 7 months, they remain very strong. Union AMC has been growing quite well, thanks to support from our distributor partners. We have been increasing our market share. Our growth rate is, at least 25% more than that of the industry. Overall AUM today is hitting 14,500 crores. And this year we should be definitely crossing 15,000 crores. And our target is to hit 25,000 crores in the next financial year. So the company growth is there, and the team is now, all set with Harshad and Sanjay and Hardik on the equity side, and of course, the fixed income team remains intact under Parijat Agarwal. So even the fixed income performance has been improving in the recent months. So we have invested quite heavily in the team, in terms of getting new tools, in terms of adding manpower. So we have, added more analysts to our team this year. And in fact, we are looking at, a certain screeners. We are looking at, multiple indicators from the market, which will help us to take better informed calls. So कई तरीके से हम कोशिश कर रहे हैं कि हमारा फंड्स का परफॉर्मेंस कंसिस्टेंट रहना चाहिए. That is the most important thing, and उसके ऊपर काफी इन्वेस्टमेंट किए हैं, and you will see the results over a period of time. Even on the sales side, we have strengthened the team. We will be adding more locations in the coming year. We'll be opening more offices. That will happen. And we are also increasing our digital marketing efforts. So you will see more and more digital presence, electronic presence from our side, right? So a lot of effort is being made, and we have full support from our sponsors. तो कंपनी का अभी ग्रोथ काफी अच्छा है, और with your support, I think we will be able to continue to grow at a faster rate in future. Does that answer?
Thanks, Pradeep. Yes, thanks a lot. And with that, we come to the end of the call. Thank you, everyone, for joining in, and we look forward to your support for the NFO and all our other schemes. Thank you.
Thank you.
Thank you.
धन्यवाद.